Okay. Oh, good morning. We'll start chapter. This will be the video for chapter 4. It's a long chapter. Again, I've covered it a lot. Certainly I've covered it in class. We've given homework. So this is just an additional resource, not of course not the only resource. And you've read the chapter, and I give you group homework. And it's the fall of 2020, and it's Wednesday morning. So let's go. Again, by the time you see this, I've already covered. We've had 2 classes on it, and we'll have 1 more class tomorrow. Here we go. Let's share the screen here. So here are our slides. Okay, we're going to talk about adjusting entries this chapter. So in chapter 3, we talked about basic recording of journal entries, like when we buy, we pay for prepaid insurance in advance. We debit that as a prepaid asset, credit cash, or maybe credit accounts payable if we paid for it on account. We talked about maybe if we receive cash in advance of performing a service, we would debit cash and credit unearned service revenue. We didn't talk too much about what if we incurred expenses, but we hadn't received a bill for them yet. What do we do about that? But we're gonna what we'll do here, and this is in this chapter, we'll teach you how to record journal entries for accrued expenses, and then we'll go through the trial balance. I'm going to skip closing entries because none of you are accounting majors. You'll never see them. So here we go. I think we'll talk about some general principles first. So the accrual basis of accounting. So accrual basis is GAAP. Okay. So that what might that mean? I'm going to skip that. I guess the key thing. I don't like the term periodicity assumption. But what you should know is companies, certainly public companies, and we've covered this, prepare condensed, condensed, i.e. not full financial statements on a quarterly basis that they submit to the SEC, Securities and Exchange Commission, and their shareholders. And they do a more comprehensive report. The form is an annual report on Form 10-K at the end of the year. And again, that goes to the SEC and to their shareholders. And lots of people at Wall Street look at that report, okay? But even in between a quarter, let's say if you're a calendar year company, you'd have quarters that end on March 31, June 30th, and September 30th, and of course the year end would be 12/31. So even though January 31 is in a quarter, companies probably prepare financial statements on a monthly basis to keep track, so that keep track of how they're doing in the quarter. Again, they're usually providing some guidance to Wall Street about what our sales level and what our earnings per share is going to be. And they want to make sure hopefully they're on track to hit that. And if they're not on track to hit it, they warn Wall Street that they're not going to hit it. In many cases, but not in all cases. Companies should, we're going to skip that. All right. This is important. Revenue recognition. Revenue is recognized in the accounting period in which the performance obligation is satisfied. So it doesn't matter when we get the cash. We recognize revenue when we perform the service. So if we painting a house, we can recognize revenue when the house is painted. If we're delivering a product, we can recognize the revenue when the title to the product passes to the customer, which is usually, most often is upon delivery to the customer. But we'll talk more about that in future chapters. So again, and that's why in last chapter, if we received money in advance of performing a service, we recorded a liability. We debited cash and credited unearned service revenue, a current liability. But it's also true if we perform a service that we don't have cash for yet, we debit some sort of receivable could be called accounts receivable, could be called accrued revenues. And we recognize the revenue even if we don't have the cash, because we're using accrual basis accounting. That's the rule of the GAAP, not cash basis accounting. Okay. We're not. This is I could do a whole semester course just on this slide, but we're not going to do that. So we're not going to take you through that. Okay. Not in accounting one. Expense recognition principle. We record expenses in the period in which we consume assets or incur liabilities. So, what does that mean? So if we have prepaid, what does consume assets mean? So if we have prepaid insurance, we buy 12 months, of it. Every month it expires or we consume some of it. Or if we had bought supplies and we used supplies in our process, we're consuming those assets. So in each case, we recognize the expense when that happens. Or we'd, if we're painting a house, we would use the paint. If paint was paint might be an asset, probably would be an asset if you're painting a house. And as you use the paint in order to paint the house, you recognize the paint expense along with the revenue. And they say let the expenses follow the revenues. They call that the matching principle. Okay, the matching principle. Match the revenue, match the expenses with the revenue. So record the expenses roughly when you record the revenue. That's a general guideline. Again, that is not always true either. But it'll be true for this course. So forget the periodicity assumption. Look at the rev rec principle. We recognize the revenue in which the performance obligation is satisfied. And that's the same. Performance obligation could be what it is you promise to do. Paint a house, that's a service. Do an audit, that's, we deliver that by hours. It might be that you sell consulting hours. Every hour you deliver to the client, you maybe get to recognize the revenue for that hour. It might be that you selling thermoses. You can recognize the revenue when you give the thermos to the customer. Okay. In the expense recognition, like we recognize the expense for building this thermos when we sell it. That'll be something we could talk about as cost of goods sold in a chapter or two. The paint would be to paint a house. It would be cost of goods sold, and we would recognize that as expense when we recognize the revenue. Where's my cursor? There it is. So which one's true here? Oh, they're asking for which one is false. Okay. So the events that change a company's financial statements are recorded in the periods in which the events occur. I think that's true. Revenue is recognized in the period in which the services are performed. Yeah, I think that's true. And the services performed, when the service is performed, that's the same, just different vernacular for we've completed the performance obligation. The accrual basis accounting is in accordance with GAAP. That's true. The last one, revenue is recorded only when cash is received and expenses recorded when cash is paid. That is false because that's cash basis accounting, which is not in accordance with GAAP. So yes, the answer, that's false, okay? I'll let you look at that, but we've covered that. Cash-based accounting, we're not going to follow. But some small companies, very small companies, maybe some of those sole proprietorships, they might use it because cash basis might. You sell cash basis may approximate the accrual basis, so it's just easy to keep track of, and then you don't have to do any of these adjusting entries that we're going to talk about in this chapter. All right, so we'll talk about, so this is actually a good example of comparing accrual versus cash basis accounting. So we have, across the top, we have 2 years, 2021 and 2022. So see, 2022, no one's wearing masks anymore, right? Because the pandemic's going to be all over. They're not 6 feet apart. It's going to be a good time. So here we are, painting a house. So in 2021, I don't know what the, I guess in 2021, so we purchased the paint, we painted the building and paid employees. So in the cash basis, we didn't get paid. The Fresh Colors paint company did not get paid. So in the cash basis accounting, we would have 0 revenue, but it would have the $50,000 of expense, probably for paying the employees and purchasing the paint, okay? So that shows a loss in this job of $50,000. But that's not really what happened. They're gonna get $80,000 for this, right? So the work was done, they just don't have the cash. So the accrual basis would say, yeah, but you have to have the revenues and expenses match up in the same period and recognize the revenue when the service is done. So if we paid it in 2021, even though we don't have the cash, we'll recognize the $80,000 and the expense, $50,000. So that gives us net income of $30,000, all in 2021, and as opposed to $50,000 loss under cash basis. And in 2022, under the accrual basis, would give us 0. That's because it was all the only thing that happened in 2022 was we received the payment. But that doesn't matter under accrual basis, okay? For the income statement. And so here you'd have a mismatch. You'd have the revenue under cash basis in 2022 and the expense in the wrong year. So that doesn't make a lot of sense. That's why we follow the accrual basis. All right. So when we recorded like our initial journal entries in chapter 3, excuse me, like on prepaid insurance, you know, after a month, we've consumed a month of that prepaid insurance. So it's not, if we paid $1,200 for a year's worth, after 1 month, it's only worth $1,100. And that $100 difference needs to be recognized as an expense in our P&L. So we have to, that's why we need an adjusting entry. We need that in case we had unearned service revenue and then we perform the service. Now what do we do? Well, you have to record the adjusting entry. We're going to show you how to do that. And they generally would include an income statement and a balance sheet account. Okay, and you'll see that. You take a look at this, but this looks like all the above, all the responses above are correct to me. Right? These are all GAAP or generally accepted accounting principle concepts. All right? Remember these concepts. All right, so here's the 4 types of adjusting entries that there are in general, but they'll be the ones we focus on in this chapter. So prepaid expenses, that's the prepaid insurance or prepaid rent as an example. Or could it even be if we bought supplies? So if we have prepaid insurance or prepaid rent, like a month after if we bought 3 or 6 or 9 or 12 months of that, we have to adjust that every month because we're using it up. That's expiring and we're consuming that. If we bought supplies and we use some supplies, we're consuming that. Some of those have to be an expense. Let's see here. Under accrued revenues, that's where we perform revenue. We perform services, but we haven't received the cash yet. But because we perform the service, that's the key to recording the revenue, right? So, so we'd have to recognize revenue even if we haven't got the cash in yet. On unearned revenue, we talked about that. We get the cash before the service is performed. But when we perform the services, nothing magically happens in the accounting records. We have to go in and make an adjustment to make it happen. And on accrued expenses, it might be, let's say you pay your employees once a month on the 15th of the month. So at December 31, there's 2 weeks of employee expenses that haven't been paid. You're not going to pay those till January 15th. But if that's the end of your calendar year, we're going to have to record an entry to reflect the fact that we owe people for that 2 weeks. We just happen to pay them once a month. So we're going to record an adjusting entry on wages and payable and other items like that, like a utilities expense. Here we go. So it's give us, this must be I think this is the trial balance from chapter 3, it says it. So we have all these items. So these are based on our original journal entries. You know, so for example, it's showing we had $2,500 of supplies, but we buy supplies because we're going to use them, right? So at the end of the month, or there's going to be less supplies left because we're using them. At prepaid insurance, we have this amount, but we know that's going to expire on a monthly basis or a daily basis, but we'll prepare the financial statements once a month. We have equipment. We talked about we'll have to record depreciation. It doesn't record itself. We have to record depreciation every month. So those we know. Unearned service revenue, we'll have to evaluate whether we've gone ahead and earned it. So those are the ones that at least initially, you know, look like the adjustment might be needed. Salaries and wage expense, you know, I'd have to see when, do we pay that right at the end of the month, or do we pay it sometime in the month? So therefore, we need an adjustment to accrue the expense through the end of the month. Okay, let's see what we got. All right, this is what we talked about. Now hang on to pause for a second here. We'll be back. All right, so I'm gonna reshare the screen again. This is a long chapter. I gotta take some breaks. I like these glasses. Right, I think they sort of look cool, like cow glasses, right? But I can't see out of them, so I really can't. I'm gonna have to take them off. You might say, where do you get glasses like that? Or you may not. You might say, why do you have glasses like that? I got it. Okay. So the first adjustment is going to be a prepaid expenses, right? That's where we make a cash payment before the expense is recorded. We pay something in advance. We credit cash or debit accounts payable if we paid an account. And then we debit prepaid insurance or prepaid rent. We bought an equipment or a building, or we had supplies, or we maybe bought a bunch of TV ads that, you know, or some type of advertising that either hasn't aired on TV, hasn't shown up yet on the internet, or it hasn't even been in the print media, whatever it is. All right, so. So what are we going to do about it? So again, prepaid expenses, they expire with the passage of time or through use. So the passage of time would be prepaid rent and prepaid insurance, or via use. Or I mean, expire. I guess equipment, I guess, expires sort of with the passage of time in use. You know, and we call the expense for that depreciation. We've covered that, right? So. So here's the adjusting entry. Well, the debit will be to an expense and the credit will be to the asset account, unless it's equipment, in which case it'll be to a contra asset account. So the debit, because expenses are debits, that's important to know. Again, the whole debit, what's a debit and what's a credit? Assets are debits, expenses are debits, liabilities and stockholders' equity are credits, revenues are credit, and expenses are debits. Dividends are debits, okay? Retained earning is a credit because it's a component of stockholders' equity. And then you have to know what, you know, so you have this sheet that's on Sakai. I think I held up in the last video too. Let me find it here. And you have to know that debits increase debits, and so you recognize this sheet, right? It's on Sakai, it's 2 pages. The best thing you can do for the rest of the semester is memorize this. Again, it has the account, the classification, like it's a current liability or an asset or an expense, the financial statement goes on, and then the normal balance, meaning normal balance be a debit or credit. Okay. All right, so let's see how this works. So we're saying we have prepaid insurance, and it's a month later. We're saying we would credit the prepaid insurance right here, and then we debit expense. So that's going to be a normal entry for these prepaids. Let's see what we got. So here we had, if we went back to the trial balance, it showed we had $2,500 of supplies, $2,500 of supplies. All right. And that sort of carries through here. So we're saying, initially we recorded the $2,500 of supplies, and we did that last chapter, debit supplies, credit, accounts payable, or credit cash, depending on the payer. This account shows a balance of $2,500 October 31. Well, when someone went out to count the supplies at that date, there was only 1,000 supplies on hand. So we got to get the $2,500 of supplies down to $1,000. So that's a debit. Not only do we have to reduce it to the amount that's on hand, we have to transfer the amount that was used into the P&L or the income statement. So 2,500 minus 1,000, that's 1,500. That's how much we used. 1,000 still in hand. So credit supplies 1,500 and debit supply expense 1,500. So now the total balance that'll be in supplies is the 2,500 debit minus the $1,500 credit, and that's $1,000. A debit balance will be in your T account. Here's the journal entry. I think they'll show us the T account later. And this one, make sure we're recording. Yeah, okay. All right, so good. They're going to show us. Here was our initial entry when we bought the supplies, the 2,500. Our initial entry, we bought supplies for 2,500. We went out and counted that there was only 1,000 in the stock room or wherever they are. So we had to make sure we ended up with $1,000 at the end of the month. Okay. So the adjustment is a $1,500 credit to get it to 1,000. 2,500 credits reduced debit, so 2,500 minus 1,500 is 1,000. And because we used it in the course of our operations, it has to be reflected as an expense. So we put in supplies expense, and expenses go in the income statement. That's where we compare revenues and our expenses to determine our net income. Hopefully, could be a net loss. Net income if revenues exceed expenses, net loss if expenses exceed revenue. Okay. Now here's the insurance adjustment. So it says Sierra Corp paid $600 for 1-year policy. Coverage began on October 1. So initially they debited prepaid insurance of $600 and credited cash, right? So if it's $600 for a year, that means it expires. You take 600 divided by 12, it expires $50 a month. So here is at the end of October. Now watch out, these exams, you might have to calculate 2 months or 3 months or some period of months of expense. But in this case, it's 1 month. So 600 divided by 12 is 50. And again, we debit the expense account, we credit the prepaid insurance. Hopefully they'll give us that same presentation as they did for supplies. Here it is. So this is a good presentation. We know the journal entries, debit expense, credit prepaid insurance for 50. Initially, our T account had 600 for a year's worth. We take off 50 for a month now. After 1 month, the amount that's prepaid is only 550 because we've used a month. It's 11 months that are left that are prepaid, and the amount that it's expired has to go to the expense on the income statement. All right, easy peasy. Well, this is a tough chapter, so this has historically been, even though it's easy for me, of course I've been doing this for between accounting and work for 40 years, so I guess it should be easy for me. All right, we've talked about depreciation. It's the process of allocating the cost of an asset to expense over its useful life. So if I buy a van, maybe useful life, delivery van might be 5 years. If I buy a building, the useful life of that's probably, or manufacturing plant, that's probably somewhere in the neighborhood of 30 to 40 years. I think 40 years is the maximum life you're allowed to have in the gap. That's my best recollection. Oh, it was at one time. So what we have to do is get the cost of that over their useful life. We have to get the cost of that asset recognize that as an expense because as we use it up. Okay. So this is really the depreciation is more allocating the cost of the asset to expense as opposed to trying to determine the current value of the asset, because it could be that the values of my house is 50 years old, but it's worth a lot more now than it was when I bought it, for example. So it's not a valuation concept, it's an allocation concept. To make sure that what we initially put on the balance sheet over time gets into the income statement, okay? And again, we recognize an expense, and instead of crediting the asset here though, and we've talked about this, we credit accumulated depreciation, which is a contra asset, all right? And so here they give you the base case that, that they calculate that the depreciation is $480 a year or $40 a month. So that's because 480 divided by 12 is 40. And so they record a month of depreciation expense and a month accumulated, and then they assign that to accumulated depreciation. Depreciation expense goes in the income statement. Accumulated depreciation is a contra asset that reduces the value of the asset in the long-term section of the asset section of the balance sheet. All right. And here it is. Debit the expense, credit accumulated depreciation. Take a look at this. Looking in here, debits increase expenses, debit depreciation expense, credits increase contra assets. I'm flying, but you can slow this down and rewatch it. All right, so there's your entry. So there's your initial, you buy the equipment for $5,000. Again, we're not going to credit the equipment. We're going to credit this accumulated depreciation account and debit depreciation expense, okay? And then on the income statement, we net this out. So we have 5,000 less accumulated depreciation of 40. The net value of equipment is at that point, net book value would be, so what they call net book value would be $49.60. See if they show that in the next slide. Yeah, there they are. This is how it's presented on the balance sheet. All right. Let's see. This is a summary of what we just talked about. I'll let you look at that. I'm not going to read it back to you. This is why you need the adjustments. Because the asset, they've been used. Prepaid expenses have been used. The building is depreciating. We use some supplies, prepaid insurance and prepaid rent are expiring. Some of the prepaid advertising has been given to us. You know, either it's been aired on the internet or on TV or used in a news, you know, print media or billboard. All right, now we're going to go to unearned revenues. So, you know, in all cases, it's where we receive cash before we provide the service. So rent, you might pay, you know, we might be a landlord, you know, we're renting things out. We get paid maybe just at the beginning of the month, or maybe, you know, in advance for 6 months. But, you know, if it's in advance, we can't recognize the revenue until the person uses that space. So whatever we're renting, could be an apartment, could be a copy machine, could be a car. We'll recognize the rental income over the term that they're renting it as time passes. Airline tickets. We all pay for airline tickets in advance, right? Often 2 weeks in advance, a month in advance. Maybe those students that are on campus that are going home for Thanksgiving, Christmas, maybe folks have already purchased the airline tickets if you have to fly. Certainly a normal semester. That's what we used to do. By now, we would have had our sons' Thanksgiving and Christmas flights booked home. But the airline can't recognize so we paid the airlines, but they can't recognize the revenue until we actually use the flight. So when they get that cash, they debit cash, credit unearned revenue. And yeah, there's other things. You know, someone could pay me before I paint their house. You know, that would be like a deposit, and that would be unearned service revenue. And you might buy a magazine subscription. You know, a year's worth you're paying in advance. Again, that's also unearned revenue. Credit cash. I mean, when you receive it, debit cash, because I'm providing the subscription, or the airline's providing the ticket, or the landlord's providing the rent. So that in those situations, I'm receiving cash in advance. So I debit cash and I credit some sort of unearned revenue. But like as time goes by, you have to reevaluate if that's the right value for the unearned revenue. Maybe I've earned it. And again, as a month, when you're renting something out, you recognize that the rental income ratably as time passes. When airline tickets, you recognize that when the flight's used. Magazine subscription as the months pass, and other customer deposits when you perform the service obligation. I'm gonna take a little break here. Well, I guess I'll stay. I guess I'll get through it revenues first. Okay. So here's the entry. If I have a unearned revenues or liabilities, so the unadjusted balance would be a credit. So I'm going to debit that if appropriate, if time has passed. If there's an adjustment to be made, it's going to debit. I'm going to bring the balance down and credit some sort of revenue account. Okay. That's what it's going to be. Debit the liability, credit a revenue account. Like if I received a deposit to paint a house, and initially, so debit cash, credit unearned service revenue for $1,000, I have that here. When I paint the house, I don't have any liability anymore because I've done it. So I debit the liability $1,000 and credit revenue, and I get revenue because I performed the service obligation, completed the performance obligation. All right. So here's an example. Debit. We received $1,200 from a client for advertising services that we're going to complete by December 31. So initially we would have debited cash $1,200 because we received cash, credit unearned service revenue $1,200. And then at the end of October, we said, okay, well, how much did that $1,200 of advertising did we provide? And here we say we provided $400, however they calculated it. So now our liability has gone down by $400. So we debit $400 and we recognize revenue for $400. All right, let's see if they give us the journal entries. All right. And here they do. Here's the entry: debit unearned service revenue, credit service revenue. And here's what it shows the impact is on T accounts. Initially, we had $1,200 of unearned service revenue, and we debited that by $400 because we provided the services. Debit that and credit revenue. We get I don't know what the 10,000 is. That's something else. But here we had $400 worth of revenue. So our balance, the liability of advertising is $800 now. Again, it was initially $1,200. Some gave us $1,200. We did what we're supposed to do for $400 of it, but we still have work to do on the other $800 of it. Okay. All right, I'm going to take a break here. I will pause this, but I will be back. Okay, my break's over. Let's do a little bit more here. All right, so I think this is where we left off. I think we pretty much were done with liabilities here. I think this is a good summary of that slide. I think that is where we left off. So we'll move to the next slide. All right, I think we did this in class, but let's do it here. Prepaid and so here are the oh, I'm not sharing the screen. One moment, please. Okay, there you go. So this was next. What I was talking about in this slide, this was the summary of where we just finished up. I'll move back to that slide. Just before I took my break, we finished with this slide on unearned revenues. Now we're going to move on to deferrals. We're going to practice it. That's the prepaids and the supplies and the equipment. So these were our basic, this is our unadjusted trial balance, okay? A portion of our unadjusted trial balance. It can't be the whole trial balance because it doesn't balance, right? So it says select accounts. It's before adjusting entries. So these are just our original entries. where we paid for prepaid insurance, bought supplies, bought equipment. It must have been some, in the prior period, we must have taken some amount of accumulated depreciation, which this would have arisen via an adjusting entry, but just in the prior period. And then we had unearned service revenue, where we'd receive cash in advance of performing the services. So the first thing is, someone went through, a good accountant went through this and said, hey, you have $3,600 prepaid insurance. If it expires at 100, it must be good for 3 years of insurance. So if it's expiring, $100 per month. And it says supplies on hand. Initially, we bought 2,800 of supplies, but now we went out and counted it. We only have 800. And then the equipment depreciates at $200 a month. And then during March, services were performed for $4,000. So of this 9,200 that was unearned at the beginning of the month, we earned 4,000 of it. So now we're going to prepare the adjusting entries. There's the insurance expense. Again, debit expense, credit prepaid insurance, covered it at nauseum. Supplies expense, I think they said we had $800 left at the end of the month. So if we had 2,800 to start with, we're going to reduce the 2,800 to 800 by a credit of 2,000, and then it becomes an expense. So debit supplies expense 2,000 because we've consumed them, the supplies, and then credit the supplies to the balance sheet account to get the supplies balance to be what's left on hand, which is 800, which is 2,800 debit minus $2,000 credit. Okay. Depreciation expense. This is where we use this contra asset account. So it said the equipment depreciates $200 a month. So debit depreciation expense in the income statement, and credit accumulated depreciation, which is a contra asset to the equipment, which is a long-term asset. Okay. And we showed you how that was presented on the balance sheet a few slides ago. Unearned service revenue. Again, we said we earned 4,000 of the 9,200. So we're going to reduce the amount that we owe now is 5,200. So we debit unearned service revenue, and now we've earned it, so it becomes actual revenue, service revenue in the income statement. And those are adjusting entries. Now what's going on? I guess we're off of that. Those are examples of what we covered. And we're going to go on to adjusting entries for accruals. And accruals, here's what an accrual is. You have revenues accruals and expense accruals. In revenues accruals, where we performed the service yet, but we haven't recorded in our accounts, in our records. Maybe because we haven't sent a bill out. That'd be a common reason. Maybe because we had to calculate how much revenue we had earned. And expenses are incurred, but not yet paid or recorded. They're not yet paid and recorded, actually should stay, at the statement date. And so why is that? Because maybe we didn't get a bill for our electricity expense. And we get an electric bill, we debit expense, credit, electric, some sort of payable account. But if we don't have the bill yet, it doesn't mean we don't owe the money. So we have to record an expense for that. Just like if we did revenue and we didn't send a bill out, like if we had a normal sales transaction, we would credit revenue and debit accounts receivable. That would be the normal transaction. But if we haven't sent out the bill or the accounts receivable yet, again, we have to record it ourselves via these adjusting entries. Otherwise, they would happen automatically. All right. Accrued revenues occur. We'll focus mainly on services, I think, in this on my exams. Well, I guess there could be some interest. Probably, where we perform the service and we haven't sent a bill out yet. Someone asked a good question in class the other day, like, why might that happen? Well, it could be we performed the service or sold the product like the day before, a few days before the end of the either the month or the quarter or the year, and it takes a few days to get the bill out. In some cases, why? Because you need to have the bill reviewed for accuracy and make sure it's for the correct amount. And there's some controls that you apply before you issue the bill, so that could be the reason. On interest earned, if you loan money to someone, maybe you only collect interest, once or twice a year, every 6 months or once a year. So therefore, every month you're earning interest, but you're not billing them, right? So you have to take, you know, a month's worth of interest every month. And we'll pass on rental's the same idea. So here's the entries. We're going to increase an asset account and increase a revenue account. So if it's for services that we performed that we haven't received cash and we haven't billed yet, we'd have to debit one of two things: accrued revenues, that's an asset, or accounts receivable. I'd accept both. And credit revenue, because again, we get to record revenue when we perform the service. So it doesn't matter whether we've got the cash, haven't sent a bill out. The guiding principle is we get revenue when we perform the service or complete the service obligation. So they're going to. So here they're going to call it accounts receivable. It could be accounts receivable or accrued revenues, right? It could be either one on the balance sheet. So these are performed services that were not billed to clients, okay? Again, I think well, we'll go with this simple step. I think they're missing a step, but debit accounts receivable, credit service revenue. And when the customer pays, of course, we have to send them out a bill before they pay. But when they do pay, we'll debit the cash and then credit the accounts receivable. So now the receivable cancels itself out to zero. And the net effect of the entire transaction is debit cash for 200, credit service revenue. So it's more of a timing issue, okay? But we don't wait till the cash to come in, because that would be cash basis accounting, and that is not GAAP. We don't wait for it to recognize the revenue. So here's our the $200 receivable adjustment and the $200 service revenue adjustment. I think we started out with, I forget what the 10,000 was, but that wasn't that was probably just off the regular trial balance. That was our first adjustment that we made, probably for unearned service revenue when we performed the service, I think. And then, and here's another adjustment where we have revenue in advance of billing it or receiving the cash. So debit receivable, credit service revenue. And I'll let you look at that for a second. All right, now expenses. Again, just because we recognize expenses when they're incurred, not when they're paid, because if it was paid, it would be the cash-based accounting. So just like when we prepay an expense, we don't necessarily recognize the expense. If we haven't been billed or paid for something, we're still going to record the expense. We're going to accrue the expense. So it could be salaries and wages. I think I used the example earlier that say the workforce of the company gets paid on the 15th of each month, and at the end of the year, December 31, let's say that's a year end, that the company owes the workforce 2 weeks of salary between December 15th and December 31st, even though it's not going to get paid till the next January 15th. So that has to be accrued. Same thing could be income tax, or it could be any kind of taxes, but let's say it's income taxes. A lot of companies have to pay those, I don't know, as into sometime in maybe March 15th. It's different due date than personal income taxes. But let's just say we know our personal income tax is 4/15, so it's the same concept. So just because you don't have to pay them till April, you have to estimate them on a monthly and a quarterly basis, and certainly on an annual basis, and record here your debit expense and credit income taxes payable. Same thing for interest. This is the other side. If I borrowed money, but I only have to pay interest twice a year, every month you still have to recognize interest expense, debit interest expense, credit interest payable. And rent expense, this is, again, the same concept. We'll leave that alone. So the accrued expense entry is debit expense and credit the liability, be it income tax payable, salaries and wages payable. What are the other ones? Could be, I don't have an electric bill in time, so I have to estimate the electric bill. So I have utility expense and utility expense payable, which would fall under the caption of accrued expenses. So here's the calc of interest. And sort of, I'll leave it there, but that's sort of self-explanatory. remember on our exams, you have to figure out if it's you're accruing for a whole year, 1 month, 3 months, whatever the period is. Pay attention to what the words are. I'll let you look at this again. This is accruing 1 month of interest expense. They calculated 1/12 of the. I'm not going to go back and repeat it. It was self-explanatory. So that's that. All right, here's the accrued salaries slide. So they paid October 26th. The next payment is not until November 9th. So for 5-day work, or $400 a day. So they owe for, it looks like they paid here. Last they paid on the 26th, and that's supposedly through the 26th. They get $400 a day, work day. And they're saying the work day is the 29th, 30th, 31st. So how much has to be accrued? Because it's not going to get paid until November 9th. But at the end of October, you owe 3 days, so that's $1,200. So I would think the entries, salaries and wage expense, $1,200, and salary and wages payable, $1,200. Let's see if I'm right. Yes, I am. Okay. Now you take a look at that slide. All right. Entries T accounts. The 26th, that 4,000, that's what they paid. Oh, sorry. They get paid, they were last paid on the 26th, so that. So somehow they said, somehow it had 4,000 in there. I'm not sure why that's the whole balance, but anyways, we'll focus on the adjustment, right? The 1,200, the 3 days at $400. All right, there's that. There's that. I'm going to pass on that. All right, we're not going to do. So now this is the adjusted trial balance. I wish I could put the other one up on the side. So the beginning balance we made adjustments to, and here's the one after that. And it's from this account, it's from this statement that you could prepare financial statements. And perhaps we'll show you how to do that tomorrow in class. So from this, we should be able to prepare financial statements. And there is one trick to it. And I think the trick is that we do the income statement first. Now this is where you have to know what goes in the income statement, right? I'm not going to do it all here, but if you wanted to try this, you take the revenues and the expenses, revenues minus expenses, and that would give you net income. And then you do the retained earnings statement first, okay? Then you go to the retained earnings statements. And this is beginning retained earnings at the beginning of the month. So you do beginning retained earnings plus net income less dividends, and that becomes the retained earnings that you use in the balance sheet, and then the balance sheet should balance. All right. And that is so let's see if they did it. So they did exactly what I said. They took, first thing they did, they come up with the income statement. This is off the trial balance, adjusted trial balance. They take the revenues and the expenses. They give us net income of $2,860. Again, this retained earnings balance is at the beginning of the month. So that's 0 plus the $2,860 from the income statement, minus the dividends, and that's the retained earnings at the end of the month, $2,360. Okay, and so that'll go into the balance sheet, which will hopefully be on the next slide. Yeah, So there's the 2360 retained earnings, and then you just have to know which ones are your balance sheet accounts and where they belong. So we got the assets here. They didn't really say, they didn't do a classified balance sheet, but where they stopped current assets and non-current assets. And then they took equating equipment less the accumulated depreciation. Remember that? The 5,000 minus the 40, 4960. So that equals assets. There's the total assets equals liabilities plus stockholders' equity, and it all balances. All right. But to do that, you have to know what every account is and where it belongs. But again, the trick is to do the income statement first, roll that into the retained earnings statement. That gives you the ending retained earnings balance, and then you can put the balance sheet together. And that's how it's done. And I'm not going to do this. Maybe in class I'll do that. See, again, they're doing just to say, well, all right, and we're not going to touch these temporary and permanent accounts. So that is all for chapter 4 on the video, anyways. Put this up soon. Have a great day, everybody.